Our chief equity strategist and economist, John Blank, takes a look now at the regional bank crisis and any impact it may have on the economy. John, how much stress has actually been put on the banking system up to now?
Yeah, Terry, we got to a financial stress index back in March on St. Patty's Day, March the 17th at 1.51 on the St. Louis Fed Financial Stress Index. Just to give you an idea how that compares in COVID, Friday, March the 20th, 2020, it was at 5.3. And in the financial market crisis, it got up to 9 something. So you can see that 1.5, even when the midst of the regional banking crisis was going on, was nothing compared to these two. Now, to tell you what they are today, we're talking May the 31st. I have the May 25th era financial stress from the index from the St. Louis Fed. It is at 0.48. 0.48. So it's a third the level of a month or two ago, and it's very, very low. So keep in mind, right now on May the 31st, there's absolutely no stress on the regional banking system.
And what banks would we think would be affected here if there were? Large, regional, small?
Large, regional, and small. All of these banks are in there, rolled into that stress index.
Okay. You wrote recently that this whole thing appears to be a second-order financial event, and you're kind of underscoring that here. Where the broader economy-wide effects are contained by swift actions of the U.S. policymakers. So does that mean that there's actually not much to worry about?
No, it means that we got to worry about something other than the regional banking crisis coming from Fed rate hikes, because the Fed has encountered that and dealt with that. Well, the commercial real estate crisis is still out there, and the housing market bubble is still out there. It's just that these two may become a crisis in 2 years, not 2 months.
So on the minds of many, the major question posed is this one. Is the financial stress caused by the regional banking crisis up to now so significant that the U.S. economy staggers into a recession?
Well, again, a 0.48 on the St. Louis Fed index when 1 is the standard, when we're half the stress that's typically seen normally. The answer is absolutely not, until we see something else emerge.
And while we're on the subject, what's the likelihood of a monetary policy-induced recession, especially given the latest batch of economic data that came out last week?
Still wait and see on that, Terry. People are loving the idea of being, the black swan and calling this great turn. I warned people that the consensus expectation for payrolls this week on Friday is plus 195, which is not a recessionary number. The weekly unemployment gains are going down again, which is not recessionary. So we're going to have to wait a few more months to see recessionary data from the economy, and that means there's no recession now.
So against this backdrop, are banks going to be tightening their lending policies for the rest of the year?
You got to understand, if you look at bank tightening in the Fed system, that started when the Fed stopped QE back in 2001. The banks are already in a tightening scenario. They start tightening when the Fed starts tightening. That's how it works, and that began a long, long time ago, before the interest rate hike.
What about lending at small domestically chartered commercial banks? Did that take any kind of a hit during that period?
Absolutely took a hit. Very small hit, though, and now it's recovering. So people, again, got to understand that the small banks are back to lending, and certainly they got their mark-to-market mortgage-backed securities off their plate because they sold them to the Fed. So, yes, they are definitely back, and we're seeing it in the data.
How might the policymakers respond to any other shoe that were to drop?
Yeah, we need to understand that, you can throw your textbook macroeconomics studies out the window right now, because emergency actions were taken in 2008 and 2009 that led to permanent decisions by the Fed for the next 15 years, zero rates and quantitative easing. That's a really aggressive use of emergency measures. Nobody's ever challenged that at the Supreme Court level, but it was extremely aggressive, and that has changed the game altogether. Now, the Fed, you don't want to fight the Fed, and the Fed is now this permanently enabled emergency measure Fed. Keep that in mind.
Speaking of the policymakers, I have to ask, what's your take on the new deal on the U.S. debt ceiling?
I think it's great that we got a moratorium on 0% growth in spending for the next 2 years, because You do not want expansionary fiscal policy when you have high inflation. That is clearly smart, and I'm on board with that. It allows the Fed to not have to go as high with their interest rates and actually cut sooner if they get the turn in the inflation at the core level down. So from a fiscal macroeconomic perspective, it's good news. We need to wait and see, though, how it plays out in the macroeconomy. It's still a very tangled, interwoven mess out there, and every economy is a little different.
All right, here are 3 large cap consumer oriented stocks on your radar: McDonald's, Bookings Holdings, and Marriott International.
Yeah, of course, Terry, these are consumer spending stocks. We want to point out that the spending out there in the economy is extremely strong. Let's talk through this data just so people understand this. McDonald's, yes, that is the McDonald's of fast food fame. Number 2 ranked stock, A for growth. I just went through one yesterday, packed, and I even had to park after the drive-in to get my food in time. It was that packed. So McDonald's not going anywhere. Estimate revisions up for this year 5%, next year 4%. Next year up 4%. Booking Holdings, of course, this is travel. Again, you're looking at estimate revisions up this year 7.8%. Next year up 6.1%. A for growth. No sign from travel that's anything but booming. We saw Memorial Day weekend, we finally did the TSA counts at airports above the pre-COVID levels. So there's no question people are traveling more than ever. Marriott International, staying in hotels, number 2 on-rated stock, A for growth. Estimate revisions this year, 8.3%. Next year, 6.5%. So again, the consumer's not looking to turn down this year. And frankly, these analysts who do not do any macroeconomics are also raising their estimates for next year. I'll let you think about what type of recession is coming out of that.
All right, our chief equity strategist and economist, John Blank, on banks and the economy. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.